I do just want to give a quick preface to what this Spaces is, what our goal is here, and I'll introduce our speakers, let them come in and get their thoughts out there, their intros. But quickly, this is a long-term investing space. There is so many spaces on Twitter, and we love it. There's so much content out there, but it feels like there's a void. Not that many people talking about long-term investing, doing these deep dive into stocks, trying to get people, telling them not how we can trade and make money, which is great. We love those technical analysis spaces, but how we can invest for the long term, build wealth. So we love to kind of come in and do those spaces. It's definitely a passion of mine. Brad's been doing all of these with us, so 100% a passion of his as well. And Simon from Seven Investing, if you've been seeing and following him, what he's been doing and his company has been doing, you can definitely tell that this is something they're passionate about as well. So yeah, our goal with the spaces is to educate, inform, whatever else we can do through that. We're going to talk through some topics. Brad's going to talk through a couple of his earnings. Simon's going to talk through a change up that's happening in the ad tech spaces. It's really great to listen to what they're saying and take what they're saying. But I think the next level to this is kind of listening to the numbers they're saying, the terms they're saying, the stuff they're looking at when they get these bullish calls. And, once you can start getting that and making your own decisions for it, that's when you're going to really take this to the next level. So just want to get that out there quickly, and I'll throw it over to our speakers for a little bit of an intro, hear how their weeks have been in the market, anything else that's top of mind to talk about. But Brad, how are we?
Yeah, doing well. Busy week for me. Have 5 earnings reports to talk through. 4 of them, or actually only 3 of them, pretty pleased with. One of them not so pleased with, and then Duolingo's this afternoon. So we shall see how that goes. But yeah, excited to talk through whichever ones you guys want to talk through.
Awesome, dude. Excited to hear those. Always love having Brad on these spaces. He's the regular. We've been doing this with him every single week, so make sure you check him out. Make sure you also check out Simon, who we're going to come to right now in Seven Investing. Simon, how are we?
Hey, Evan. Thanks as always for having me on the show. I'm certainly glad to be here and chat about long-term investing. It takes a long time for management to play out those strategies, and a lot going on. I'm going to chat with you a little bit here about digital advertising. Definitely some changes taking place in that industry today.
Awesome. Very excited to hear that, Simon. Quickly, I was looking back through the recommendations on Seven Investing. I can tell you, Simon, it was very impressive. Yours were very good. So, just double enhance that of why I enjoy having you on these spaces. And, the proof is in the pudding through what I've seen on you directly. So that's pretty awesome. Big shout out to you, Simon. And I actually do want to come to you first, talk a little bit through the ad tech industry. I know we've suffered the Android curse with 1 or 2 things before, so I want to make sure we get all of the amazing wealth of knowledge from you. So I would love to kick it over to you to start and kind of hear your thoughts on it, on the ad tech.
Yes, the Android curse, right? It's especially true for these spaces. Every time I get kicked off and then try to rejoin, you've seen some big kind of changes that are taking place. And this is for anyone that is receiving mobile advertisements on either their Apple phone or on their Android device. We've kind of seen some higher level rumblings that are impacting this entire industry. And of course, this is a huge industry. Right? When you think about digital ad tech, for years and years and years, it was just Google and Facebook. If you were doing advertising online, you were using one of those two. And there's kind of becoming this new open internet initiative where if you don't want to use those walled gardens, right, you don't want to have all of your ad spend and all of the control in the hands of these giant platforms, there's kind of a new way for publishers to start using these ad tech platforms. Where if 7investing.com wanted to have some ads shown and we didn't want to use Google, we could actually use a platform to directly connect with advertisers out there. But the question is, what's going on with the big companies, the big tech companies, specifically with Apple and Google, and are they changing the entire way that personalized advertising is taking place? There's been, I don't think it's a surprise to anyone on this call, a lot of sensitivity about data privacy. Facebook was kind of in the crosshairs of that for many years. And they said, hey, rather than scraping all of our personal data and using it for things we don't know about, we think that right up front, whenever you're visiting a site or even using a device, you should have the option to opt in or opt out of actually seeing those advertisements. And in fact, this was something that Apple announced last year. They kind of got rid of something called IDFA, identification for advertisers, with their iOS 14.5 update. And it basically said, if you wanted to opt out of ads on your iPhone, you could do that. You could opt out entirely of seeing any personalized ads. And Evan, out of 100% of people, guess what percentage opted in to actually seeing personalized ads on their iPhone?
I opt out every single time. I'm going to guess lower than I'm thinking, 10%.
That's a good guess. Yes, the actual number was 20%. We're opting in. So 80% opted out. And of course, when it's that magnitude, that's got repercussions that will go through the entire ad industry. Even Facebook alone thinks that move cost them $10 billion of revenue over a 12-month period. $10 billion is not chump change. And then we just have recently seen Android taking similar steps. A little bit similar, a little bit different though. It's just more of a technology change where they're trying to cut out the cross ad traffic. Cross ad app tracking. Easier to say for anyone who's had more coffee than I had this morning. But it's basically, if Facebook used to be able to track, and what they knew about you within the Facebook app, but then also other apps that you were using too, or also with your browser. And Google is trying to make this less personalized and more at kind of a higher level, where it doesn't personally identify you specifically, but it's kind of more about the topics that you're interested in, right? If I'm looking at NFL football sites, because I'm a huge New Orleans Saints fan, am I a football fan? So it would place football ads or sports ads for me rather than Simon Erickson specific ads. And so I guess just the first topic, as a long-term investor like I am, that I'm thinking through is, what is this going to mean for anyone who plays in that space? Digital advertising, of course, a really complicated industry, very complex ecosystem. There's hundreds of companies that are in this, even if Google and Facebook have been kind of the top two for years now. What is that going to mean for long-term investors? And kind of two that are on my radar right now are Roku and PubMatic. And I can chat about those a little more if you'd like.
Definitely would love to hear that. Before we do get into that, I do just want to quickly shout out the live link that I linked up in the nest above, just tweeting out that we are live. Anyone down in the crowd wants to support us, get some more people in here. You could retweet it. I know some people don't love doing that. So just even hitting the like button on that post above, the algorithm loves that, gets sent out to everyone. So that sent out to all our followers. That would be greatly appreciated. And yes, I'm very excited to hear more about Roku and PubMatic.
Yeah, and thanks very much for the kind words earlier also too, Evan, about our recommendations that just went live at 7investing.com. We actually have a special deal for our birthday celebration. We just turned 2 years old as a company on March the 1st. And at 7investing.com/subscribe, if you want to see the details of what we're giving as a special offer, come celebrate with us. But I think
you guys put out a tweet, right?
Yes, we did. Yeah, we're actually at 105 countries who've got subscribers. It's kind of an exciting time for us.
Let me get that linked above while you're going on. Yeah.
Sure thing. Yeah, it's 7investing.com/subscribe if anyone's interested. And we've got a birthday celebration, a special promotion that we're kind of giving others a gift for our birthday, which is kind of fun. But we're talking about digital ad tech, and I think that one of the most intriguing parts of this entire market is connected TV. I know that several of your speakers have talked about this before because it's got just such a higher ad rate than traditional advertising does, right? Like if you looked at a display ad on a desktop, you might get a couple bucks per 1,000 views for that. If you're doing it something a little bit more niche, a little bit more targeted on a mobile device, maybe you get $5 or $6 for that. But it's not uncommon for a connected TV ad, right? So something you're streaming on your television, on your smart TV, that if someone's placing an advertisement into that show, because it's so much more interactive, because it sticks with you so much more than something on the internet does, you would often get $80 or $100 per 1,000 views of something like this. And so you're starting to see the Rokus of the world, the PubMatics of the world, the Magnites of the world, all of these kind of companies that have traditionally done those ad tech platforms, again, traditionally for desktop ads, for mobile ads, things like this, moving to where the money is, moving to connected TV because it's got such higher ad rates. And they're capturing, based on the format, typically 15 to 20% of the final ad that's placed. But Evan, if you've noticed, Roku and PubMatic both just got bludgeoned in their most recent earnings releases. Roku, by my count, was down 35% after its earnings. PubMatic was down 20%. There is a lot of uncertainty right now in the forward guidance. And I think that this is more of a short-term concern based on Omicron, the uncertainty that still lingers from the easing of restrictions. Obviously, businesses that are still being conducted in person. You've got a new variant out there in the United States that's gaining momentum, unfortunately. But I think that, in my personal opinion, these ad tech companies very purposely sandbagged for the upcoming quarter because they don't want to be caught blindsided. They don't want to go out and say, hey, we're going to get 40% growth. They're going to curtail that back. Say, hey, we're expecting 25, 27% growth. It's better to put the bar low and exceed that, especially right now with all the uncertainties, especially with all the changes going on in ad tech. You do not want to be setting the bar too high. And I think it's that guidance which punished these in the short term. But if they do meet that guidance and actually report a good quarter, I think there could be a lot of opportunity for any of these digital ad tech companies.
So Roku is definitely one that's a lot more known than PubMatic, I feel like. I haven't seen it. So what is exactly PubMatic, and where do they kind of lay in this realm of ad tech?
Yeah, so just another example. We use 7 Investing as another example, but say that we wanted to start placing ads on our site and we didn't want to use Google. One option would be to directly go out and reach out to advertisers and say, hey, you could place this on our website for this amount of time, or we could just do it entirely programmatically. This is kind of a new buzzword in ad tech. It's just giant auction, Evan, right? So imagine there's a room full of a million different advertisers, and I've got a space on my site that I want to fill. And I know a little bit about the audience, that's changing on kind of the identifiers of who's visiting the site. But all of a sudden, everybody can bid on that open ad space on my site. And to do that, you would work with a company like a PubMatic. This was formerly Telaria. Now Magnite is another company that's doing that. And they'll even integrate with other platforms who work with the advertisers. One company that might be familiar to several people on this call is the Trade Desk. And the Trade Desk is kind of the counterparty on the other side of these platforms who would be working with advertisers. And of course, it's all programmatic. This happens in a blink of an eye, sixth of a second. The ad tech companies on the advertiser side will coordinate with the ad tech companies on the publisher side and say, boom, perfect ad, perfect position, perfect audience, and here's the rate. And it happens incredibly quickly. And so PubMatic, and Magnite and others, those are the companies that will just take a small percentage, 15% call it, of the final ad that is placed. So it's kind of an exciting space. Programmatic is, for a long time evolved. This is probably one of the fastest moving markets of any of them that I follow, right up there with cybersecurity. But there is so many bigger level changes, whether that's Google and Apple and all the device makers, and then also just the way the platforms are identifying people because of the data privacy concerns. I mean, the long-term investor in me is kind of fascinated with this. A lot of these companies, they're only, call it $2-3 billion. I mean, they're small caps. And if you start getting some momentum, where you're moving from a 2 or 3% market share up to about a 10 or 12% market share, I mean, you're talking about a 5-10x return. All of them aren't going to do that. There's still a lot of risk in this, but there are a lot that I like in the ad tech space right now. There's too much opportunity and too weak of guidance right now. There's too much short-term focus that's punishing the valuations.
Love it. Love it. And you honestly, so you talked a little bit about Facebook as well in there when we were explaining what was happening with Apple. And that's kind of where I've been seeing a lot of this space. Like, I feel like the front and center, most being talked about, the place of it kind of being Facebook. Do you have any thoughts on what they can do in this area? Is it kind of utilizing one of these players that we're talking about here to really up their game to kind of get them to that metaverse theme that they want?
Yeah, it's all about what can you get away with personalization, right? Like Facebook's ultimate goal is to know everything about you they possibly can. But regulators don't like that, and more we aren't liking that, right? We don't want Mark Zuckerberg to know everything about us and put it into this, glorious computing center that he's just built out for AI. But he's got to frame the narrative in a way that's getting away from these pheromones that Facebook is sending off that are attracting regulators and the hatred of data privacy, right? Like Facebook has to change if it wants to stay relevant, not just get completely the hammer brought down on them. And so Metaverse and his ambitions are, okay, let's completely take a stand. Let's change the name of the company. Let's still make this all about personalization and the intent that we can find out about what people are doing. If you're in the Metaverse, you're interacting with everything that's digital. It's all code. It's kind of crazy to think about. You're in the Metaverse, you're seeing things in virtual reality, but it's all interactive code that they can learn things from. And of course, he can fine tune, what advertisements would show up, what does the subscription for something like that look like? What's a content creator on his platform going to look like? I mean, he's got a lot of levers he can pull. And because it's new and it's innovative, it's kind of sexy, it's kind of fun. I mean, it's getting away from a lot of those concerns that Facebook has kind of come under the gun for in the last couple of years. Pretty smart move by Mark Zuckerberg, if you ask me, especially as he's spending a ton of money internationally on getting mobile devices connected to Facebook in Africa. So it makes sense to me. Certainly he has a lot to lose as the technologies change that are identifying people or devices for personalized advertisements here in the United States, but he's growing very quickly internationally, and the Metaverse is, of course, a very, very, very top priority for Facebook as a company.
When was the ticker change again? I know it's soonish, or maybe it was a long time ago. I know they full on announced that it's happening. I don't remember the day they said it was going to. I feel like that's just going to be like just another step on this process of distancing themselves from the whole Facebook brand name, which comes with its problems, and will take a little bit, but the direction they're trying to go. Let me check that.
Yeah, and I mean, I keep saying Facebook, but I should be saying Meta Platforms, the new name of the company. I mean, it's down almost 50% since August of last year, right? And that is, I mean, that's 7 months ago, 6 or 7 months. You see a company of that size get chopped in half. I mean, we were talking about Meta as a $1 trillion company, and now you're talking about a $500 billion company. A lot of risk, but certainly a lot of opportunity. They've got a lot more data than most others in this industry.
Fascinating one. One of the ones that like recently you look at it and it's like these mega caps moving like penny stocks. PayPal's another one in there that kind of got that bludgeoning, we'll say. But appreciate you, Simon. Always a wealth of knowledge. I did link up in the nest above what you were talking about with the 7 investing deal that you guys are currently running for your 2-year birthday. Big shout out to you guys for the 2 years. And yeah, excited to have you on here. And if the Android curse doesn't kick in, we'd love to come back to you and maybe get some thoughts on the back end.
Thanks as always for having me. I really appreciate it.
Awesome, Simon. Big shout out to you. Make sure you're checking out the Simon's account as well. Click in, hit the follow button. But yeah, I'm gonna keep us moving and throw it over to Brad, co-host up here. This has definitely become, Brad, I do consider you a co-host on this space. I'm definitely gonna keep you up there more in the future. We've been doing this together, and I love getting as much content from Brad as possible. Very smart guy. Make sure you're checking out his timeline. Check out his free newsletter as well. I was about to say Substack, but I don't know if that's true anymore. So first of all, let me know if we're still on Substack, and then second of all, let's talk through some of the earnings we got.
Yeah, so I'm still on Substack for now, and probably making the shift over to Beehive in the near future, but won't have any impact on readers or anything. Everything's going to stay entirely free, and nothing else will change. And yeah, so pretty irrelevant for the readers, but I'm excited for the new platform. There's a lot of cool tools for me to use. But in terms of earnings from this week, I'll start with the worst first. So GoodRx reported earnings this week, and that was by far the worst first. So the highlight of the call, which I mean, Upstart had a similar kind of highlight last week, but it coincided with so much other good news that it was a little more palatable. But the highlight of this call was a $250 million share repurchase program. So that's roughly, now it's roughly 7% of its shares after the give back. But looking further down, there was not much else to be excited about. So top line missed by about 1%. And that was really related to their prescription transaction revenue business, which is by far the largest segment. We've been being told for the last 18 months that the elective care backlog that had been building in the wake of COVID-19 and people deferring elective treatments and elective therapies would eventually unwind and uncoil and accelerate GoodRx's demand growth. Now, what they hadn't really anticipated was that a lot of these prescription transactions that they're facilitating are very long-term, very recurring, chronic issues. So they are not. It's not amoxicillin if you have an ear infection or something like that. It's more so medication for diabetes and blood pressure and things along those lines. So when you miss 2 years of therapy starts and elective care starts, it takes a lot longer, or it takes a long time for those 2 years of cohorts and customers to come back and fill the void to return GoodRx to its normal growth. And had the company understood that going into this quarter and guided appropriately, I don't think there would be nearly as much negative attention on the company as there is right now. But really, just to be candid with all of you, management completely screwed up in their modeling of the pandemic and the impact that it would have on their business. I mean, and to be fair to them, no one really knew how to model the pandemic. But considering that, they should have been as pessimistic in the wake of uncertainty as they possibly could have been, and they skewed as optimistic as they possibly could have skewed. So this was certainly an expectation reset. Another thing to mention is they vastly hiked the prices of their subscription offering just because they know they're providing a lot of value and can get away with that. So maybe another little good perk to talk about. But most of this was quite negative. So adjusted EBITDA margin continued to contract to 29%. That's another thing to point out. That the company had been moving from a 40% EBITDA company to a 30% EBITDA company as it really built out its newer segments, especially telehealth, which it sells at cost to kind of use cross-selling for its other businesses. So as those products grow, margins compress. And that trend from 40 to 30 was supposed to stop at 30%. We were explicitly told by the CFO, Carson Warman, that would be the trough. We've since gotten down to 29%, and now we're being told that's the trough. But is it trough or trough? I don't really know. But I'll try to use a different word so that I don't sound silly. This was.
I believe it's trough.
Okay. Thank you for the assist, Evan. I appreciate it. So, we have to keep in mind that GoodRx's take rates continue to rise. GoodRx's market share continues to rise. This really was, and I can't emphasize this enough, just management completely messing up where they thought their business was going to be at this point in time. Forward guidance was pretty darn awful. 10% miss on the top line, 10% miss on the bottom line, and that was entirely attributed to, again, this miscalculation of we thought there was going to be a demand backlog unwind accelerating, and instead there's this compounding effect of a pause from elective care startups that is actually slowing our demand. And to me, having said all of this, it trades at about 30 times earnings now. It's a 25% compounder, and we've been told that EBITDA margin. Again, believe them if you want to, it would be fair to kind of take this with a grain of salt, but they're guiding to and confidently telling us that EBITDA margin is going to get back to 40% as segments like their pharmaceutical manufacturers, their branded segment, where they offer advertising solutions through their platforms, is extremely high margin. So as that continues to 4x year over year, that should provide a boon to margins. And as prescription transactions kind of come back over a lot longer period of time than GoodRx was anticipating, that should boost the main segment, which is higher margin than telehealth as well. We heard a lot of, we're extremely confident. We're confident that we're going to turn things around and things are going to go well and blah blah blah. But when we have this miss, when we have this big swing and a miss from management, it really forces me to kind of contemplate what that means going forward, and to contemplate how seriously we can take forward-looking guidance from this point forward. Now, I will say that this was just strike one for GoodRx. The management team has shown me no red flags, no reason for doubt, nothing but competence until this. But this guide kind of hinted at some incompetence, and pushed me towards a more cautious stance on GoodRx. With all of that being said, and I'm sure some people will think this is silly of me to do, but I have added to the company this week just because the value proposition is entirely vast and unique compared to every other competitor in their space. I mean, they offer 81% discounts on prescriptions. That's versus percentage discounts in the 50s when they went public, and no one even comes close to touching that, and their leads are only growing. This really was a matter of management just messing up and failing on telling investors what we should be expecting. To me, the business still does look healthy, but when you have a miss like that, people are just going to assume, and rightfully so, that maybe the business is not healthy. So I'm sticking with it for now. I've added to it, but this was a quarter that really used up a lot of the patience and a lot of the slack I have with the company moving forward. And it just very much so raises the bar for there not being any more of these surprises, there not being any more of these blunders for the foreseeable future going forward, for a long time. They need to be perfect going forward, in my view, because this was just an eye-opening miss, and one that is making me a tad less bullish, but still staying the course for now. I can talk about Progeny or Green Thumb or Sofi if you'd like, but we can pass it over to Simon too, because I know he always has fun stuff to talk about. So up to you, Ev.
Let's definitely go through at least one more of your earnings, and then we can kind of cycle around or see where we're at after that. Definitely want to hear one more at least.
Sure. I think people are probably most interested in Sofi. I know that's a really popular company on FinTwit, so I'll run through that one really quickly, and hopefully we'll have time to go through the other two later on in the call. But for Sofi, the quarter was fine. It was a small beat on the top line, small beat on the bottom line. The guide is what was very exciting. So the guide was an 8% top line beat. That includes some inorganic contribution, so more like a 4% top line beat. But that was that guide that they are beating was assuming that this student loan moratorium that everyone's been talking about in relation to Sofi would end and not be extended through the end of the year. Now that's being extended through the end of April into May, and this is by far Sofi's largest and by far Sofi's most profitable segment throughout the entire business. So the fact that they're still raising guidance in the wake of all of this, it's exciting to me to think where they can be when these handcuffs are taken off of their largest segment, and when they can really turn on the gas pedal in the marketing machine for their student loan product. It should be a fun time for the company. So specifically, they guided to about 1.6 billion in revenue. They were looking for 1.5 billion. The EBITDA guidance was 16% ahead of schedule. Now that's all organic. There's no inorganic contribution there because Technisys does not have any EBITDA to show for. So that raise was entirely Galileo and Sofi based. Some other interesting notes to highlight. Galileo, I just mentioned, that's their business-to-business software application programming interface provider, specifically for payment processing. They service Chime and Dave.com and Moneyline and Revolut and Robinhood and a lot of these large neobanks. This quarter, interestingly, and I think even more encouragingly, they signed H&R Block and they signed T. Rowe Price, so two real bellwethers in the financial world as new clients for an emergency savings program and for another payment processing piece of H&R Block's new app, which is called Spruce. So Galileo is planning on adding a securitized debt product, a dynamic fraud protection product in 2022. And the company, the fear was that stimulus really accelerated and pulled forward not just several quarters, but maybe a year or two of demand for a payment processor like Galileo. So just think about stimulus checks and money sloshing around everyone's pockets and the e-commerce boom. And yes, this is going to lead to payment processing demand rising. But we were all but assured that Galileo's new product pipeline, growing accounts, and new geographic pipeline is going to overcome this headwind, and that growth will remain rapid. Now, I wanted to point out that some people, I won't name names, were sounding red flags on $1.4 billion in operating cash burn for 2021. You have to kind of go into the cash flow statement and read where this cash burn came from before you can just say $1.4 billion. Yeah, that's automatically a red flag, and SoFi is terrible because the entirety of this cash burn came from a net 1.35 billion in originations and purchases of loans added to their balance sheet versus proceeds from sales and repayments of loans. So this, yes, in accounting terms, this is called cash burn, and I'm using air quotes. But really what this is a changing in capital structure, moving from cash to other assets like loans that can provide them more net interest income and boost their results over the long term. So this is a conscious decision from the company, from the CFO, Chris Lapointe, to lean more into their loan segment because they're confident in their ability to assume more balance sheet risk and to take on a higher potential for more net interest income. So moving on, so the guidance for Q1 2022 is a miss, but that is due to the fact that this moratorium was extended. They calculated the impact at a midpoint of 32.5 million, which means we would have had a slight beat. Also good to keep in mind that SoFi is operating at about I think annually it was between 1% and 2% EBITDA margin, but the EBITDA margin on their incremental business, so the brand new business that they are signing on, is 30%. So there is a lot of margin expansion to come in the future if that incremental margin stays elevated, which it has only expanded over the last several quarters. So a strong hint of forward-looking margin expansion potential, and for SoFi specifically, that hint is quite encouraging. Some other notes to go through, just reading through my handy-dandy notes. SoFi's brand awareness grew 70% year over year in 2021. And it better have, because they spend a lot of money on marketing. This doesn't include the Super Bowl bump either. But what I'm getting at here is that people are kind of pointing to SoFi's aggressive sales and marketing spend as evidence of them not really being able to retain or avoid churn of their clients. To me, that is not really the case. So SoFi is operating in a wildly commoditized sector. Even fintech is commoditized. I mean, every digital banking product we're offering, or that a company can offer, is quite similar to everything else. And the only way you can kind of overcome that is by being able to afford passing on more handsome rewards or higher yields to your consumers and the end products. And SoFi's ability to cross-sell products, not just within Galileo and its B2B arm, but also its consumer-facing products. And then it has its very own loan segment that's also very established. So it's really trying to build out this super app that is, and I quote, better together. And what this does is it opens and unlocks a lot more cross-selling ability, which makes these customers worth a lot more to SoFi than most other fintechs. And it justifies it justifies the fact that for every commercial break we watch on TV, there's a catchy jingle of getting your money right or breaking up with bad banking or something like that. It is because these consumers are worth so much to SoFi that they can afford to be aggressive, borderline stupid with marketing spend, because the LTV to CAC is so compelling, and because over the long term, the unit economics of approaching this business are wildly profitable. Also have to keep in mind that I'm talking about this LTV advantage over fintechs. They also have a consumer acquisition cost advantage over legacy banks, which kind of separates them from that pack. And that really is via not having 5 to 10,000 branches around the United States and the coinciding teams that come with that, and all of the operating expenses to raise consumer acquisition costs. SoFi doesn't have any of that. And not only does it have that advantage, but now with its banking charter and its lower cost of capital to levels more in line with banks, don't no longer have that advantage to hold over SoFi to be able to charge higher, or to be able to offer higher APYs on saving and checking products, etc. So the takeaway from SoFi from the Bears was, yeah, what's the value proposition? To me, the value proposition is the fact that they can sink their teeth more aggressively into marketing and more market share versus any other fintech, because these customers are worth more to them, and they can do so while offering APYs of 1%, which is 3 times Robinhood and 33 times the national average. And they can afford to do so, again, because looking at this competitive advantage they have over banks, they don't have this massive brick and mortar footprint to assume a lot of operating costs and to kind of tie their hands there. So it will. I mean, banking is a commodity. All of these products are a commodity. So anytime SoFi can enjoy even a modest edge is extremely key. And it's not just reserved for the consumer facing aspect of it. It's also for Galileo too, because not only can Galileo offer payment processing APIs to Chime and Robinhood, but it can also now service as this bank sponsor for these companies, which, according to Chris Lapointe, can save them about 10 to 12 basis points, or 0.1 to 0.12%, on their cost of capital for facilitating these vital functions for these processes. And I know 0.1% doesn't sound like a lot of savings, but these companies will take 0.1% any chance they can, wherever they can, because those advantages add up, and there's no point in not assuming a unit economic advantage. So just wanted to kind of defend SoFi a little bit, because there's been a lot of negative noise surrounding it, even after what I perceive to be a very strong quarter. So yes, still excited to own the company, still excited to accumulate shares. I haven't done any accumulating this week because it's been pretty flat. But hopefully, after listening to me kind of rip into GoodRx and tell you how bad that was, you can take this pretty seriously. I'm not trying to pump. I'm not trying to be I'm trying to be as objective as I possibly can. And in my objective view, GoodRx bad, SoFi good. So that's where I see things.
How do you deal with a situation where you look at a quarter and it is a lot of good numbers, a lot of good stuff, and you see the stock move lower? Is it kind of just like stock price tells you what the how the quarter was looked at, or is it really just kind of digging in there, seeing if it's overdone or anything like that?
Yeah, no, I think earnings reactions are much so more based on sentiment and expectations for the quarter than how the actual quarter proves the long-term bull thesis and the sustainable ability to compound top and bottom line. So I don't pay a ton of attention to the price reaction. Now, sometimes the price reaction is fair and makes sense, like in the case of GoodRx, it deserved to get crushed. But in the case of, I'm trying to think of another example. I think, if my memory serves me correctly, a couple quarters ago, Trade Desk reported a phenomenal quarter, and then some of the Google noise surrounding it, in terms of eliminating cookies, led to it tanking. And to me, this is that is an opportunity to enthusiastically, and slowly but enthusiastically accumulate shares, because I'm confident enough in my ability to read through financial statements and 10Ks and filings to decipher what is actually good and what is actually bad. So if, in my opinion and in my strong opinion, the quarter was phenomenal, and multiples are compressing based on price, and maybe even more so based on revisions moving higher, I'm generally exercising that mantra that we all have iron into our minds of greedy when others are fearful. But that's really only for companies that are fundamentally performing, that are doing the things that they need to do to again, not to sound repetitive, but compound revenue and cash flow at a significant enough pace to make the internal rate of return on the investment compelling enough for me to be involved for the long term. So if a quarter represents another data point pointing to the thesis being intact, but the stock doesn't follow suit, I'm generally playing contrarian and adding to answer your question.
Simon, I want to get your thoughts on that same question, talking a little bit about, when you look at earnings, you do your deep dive into it and you think it's a good earnings, but stocks getting hammered. How do we deal with that? And also in general with earnings, do you have any rules about like getting involved with it? Long-term investors should not buy before earnings. I think that's a pretty safe thing to say. But when you buy after is definitely up to strategy. I tend to wait a week or two when there's major moves, but we'd love to hear your thoughts there as well. Typical dumb question for me.
As always, I agree with Brad. I think typically when Brad says things, I agree with him, and I'll do the same thing on this one. It's I think that he nailed it when he said that it's just a question of valuation multiples versus fundamentals. And by fundamentals, I mean, earnings growth, cash flow growth, revenue growth, things like that. If you've looked at a lot of the reasons that stocks are selling off in the past 6 to 9 months, it's been based on valuation contraction. And we can probably make the case that in February of 2021, a year ago, the valuations were a little too inflated, right? Money was free, tech world was on fire, everything was going great, but really the contraction we have seen, at least for the companies that I've been following closely, have not come from deteriorating fundamentals. This is what Brad mentioned earlier, that if you see a company like the Trade Desk that's doing just fine, it's got an industry behind it, it's got a ton of tailwinds behind it, but its valuation multiples are contracting, and that's why the stock is selling off. That's an opportunity for you as an investor, at least if you think that the new valuation multiples are reasonable. And so I kind of encourage, when you're looking at a stock that sells off, as so many have lately, do you see that they are not hitting their own earnings guidance or their own revenue guidance? That's a red flag, right? If you see a company that can't hit its own internal guidance, that's something I'm staying away from. But if you see that the company is doing fine, they're hitting their own guidance, they're being transparent with investors about what they're seeing out there, whether it's ad tech space, whether it's healthcare space, whatever it is that's going on, I think that's okay. And long-term investors, those management teams, it takes years for them to play out their strategies, and things are going to change in the middle there. So if you're trying to get in and out of in a week, that's almost impossible to know what a stock is going to do. If you're trying to get it out at six to 8 months, even that is very difficult because so many things can happen. But we tend to see for long periods of time, and I'm talking like 5 to 7 years or more, the market's best performers are 70% correlated to profitable revenue growth. I'll say that again, it's important. 70% correlation of a stock's return is tied to revenue over 5+ years. And you might say, oh, well, Simon, that's obvious. Okay, but really 5 years of profitable revenue growth is not so easy to do. That's going to kind of separate out the wannabe companies from the ones that are legit and have really found their niche. If you can grow revenue for 30, 40% for 5 years, you are making an impact in the industry. And these are kind of the disruptive companies, the long-term investment opportunities, the companies that I think are worth 10x in a couple of years from where they are today, because you've got to prove it to the market that you're legit and you can stick around. And so back to the point, about valuation multiples, they're gonna jump around. They're gonna be high one year, they're gonna be low another year. But even if you had got in at the very high point of a valuation multiple over a 12-month period, if you look at that in a lens of 5 to 7 years and you've got the right company, even that is still going to provide an excellent return for investors. Ben Graham did a ton of research on this. And even the difference between getting at the very, very top and the very, very bottom for the right company wouldn't make a huge difference, like 2 percentage points a year for 10+ years. So it brings back to what Brad was saying. The Trade Desk is a fantastic company. There's some shade right now being cast on them about cookies and the Google thing. They've got OpenPath now, which is appealing directly to publishers, which is very interesting. Jeff Green, obviously visionary CEO, seems like it's doing fantastic things. There are a bunch of other companies out there like that are just going to be solidly profitable for many more years to come, in my opinion.
Feels like the profitability angle of that, or in that equation, is really only kind of became back important, which it was important forever. And then 2020, early 2021, no one cared about profitability. But you're definitely seeing the stocks that have those high growth with no profitability getting destroyed in this market. So is that kind of a little more typical to normal? I know 2020, obviously, if you're going to compare normal markets to 2020, the answer is no, the rest of the time is more normal. So I am kind of answering my own question there, but would love to kind of hear your thoughts on that concept about profitability and how it's definitely coming back into being important.
For speaking personally, and there's a bunch of different ways to invest, but there's so much attention on price to sales ratios and price to earnings ratios right now. People are saying, oh, 30 times sales is too expensive for Snowflake, and then you get a correction back to the mean, or PDE ratio of Roku was too high, or whatever the company you want to pick is. I don't pay as much attention to those. I am, as an investor, much more focused on things like what was mentioned earlier in the program, the lifetime value of a customer, versus the acquisition cost of a company. It's very important for a company like Sofi. ROIC, return on invested capital, versus the weighted average cost of capital. Are you incrementally adding value for your equity holders that is above and beyond the cost of borrowing, the weighted average cost of capital? This is an equation that when you see really, really good companies that have great projects internally that they can put their money into and compound that over a decade, that's the equation for success in long-term investing, right? You can try to jump in and out and figure out when the market's putting something on sale, or when the price to sales ratio or the price to PDE ratio is a right number or anything like that. But a lot of times that's a wash. The bigger question is, like, do you have the right people that are making the right decisions with the right market that is adopting whatever it is that this company is selling? And can you continue that for 10 years? And if you can, then my goodness, you can sleep so easy at night. If you find those right companies, you just keep adding, at more and more attractive valuations. The company that I recommended this much for March, it's got a 36% return on invested capital right now. It's borrowing for less than 10%. I mean, that's an equation you take all day when you can just kind of keep putting money into the business. You've got projects to support it. Anyways, I think that the valuation debate that is hypersensitive in the market right now, is 2022 a less expensive market than 2021 was, where stocks too expensive in 2021. A lot of that's going to be a wash. It's going to be harder to raise capital this year, yes, because interest rates are going up, and it's going to be a more challenging lending environment for a lot of companies. But I still think that the opportunities out there, try, like Brad was mentioning about, get into the 10Ks, look at the R&D line item, look at, the profitability, and if operating margins are increasing over time, that could be a telltale sign that the business knows what they're doing, their management's steering in the right direction.
Feels like, I was gonna say it's the most important thing, but there is no one most important thing. The revenue growth is in there, but a lot of this really does drive from having a management team that you can trust, and you the general direction they're going in is the right one. And trust isn't granted; it's not given, on a one-time thing. It's built over years, but it does seem like that. That can definitely take you pretty much most places in investing.
Yeah, and look at the proxy statement too, right? This is the SEC filing that you can go in and see how management is being compensated. Charlie Munger was really big on this. He's saying that incentives are everything for long-term investing. That's true. I mean, if your CEO and your leadership team is getting paid just on earnings or just on revenue, they're probably going to go out there and just acquire a whole bunch of companies and boost the top line as quickly as possible. And maybe that's not the most sustainable long-term solution. Maybe it is. Maybe, some companies do that well, but it's like, look at what your management team is getting paid to do by shareholders with your money. That is also kind of a neat little thing that you can look at and say, okay, are those aligned with me? Is that something that I want this company to be going for? Or is that something they're just going to kind of line their pockets? Nuance Communications was kind of like the worst case example of this years ago. They ended up getting bought out here just recently, but they were kind of doing the early natural language processing for healthcare. Surgeons would be talking and they'd be using this Dragon dictation software to just speak into the microphone when they would do a surgery, so they could scribe it. They could have a record of it. But my goodness, egregious stock-based compensation. Just focused on adjusted earnings and revenue growth, and that's why you saw Nuance just struggling to ever make a profit because it was going right out the door to the management team for the wrong reasons. The same thing with Activision here. There's a huge scandal recently with Activision Blizzard, but of course, now they're getting bought up as well. But they had kind of some cultural problems, some management leadership problems as well. But larger companies, the Microsofts of the world, can correct those problems, and that's why they're good acquisition targets a lot of the time. But if you want to be sustainable, if you want to think long term, management and visionary leadership is absolutely important, to your point.
So you just gave us two examples, though: Activision, Blizzard, and Nuance, talking about the stock-based compensation. And it's funny, they are both getting acquired by Microsoft. So maybe we're actually like, what's good for long-term investing is one way, and the complete opposite, Microsoft, is just sitting there licking their chops, waiting for their opportunity to come in and buy it.
Satya Nadella is fantastic at this, right? He can see the problems that can be corrected. And he knows, I mean, like a lot of the acquisitions Microsoft has made has been legacy. I would consider Nuance definitely legacy compared to some of the AI, natural language processing going on out there right now in the cloud. I would consider a lot of Activision Blizzard's franchises, the World of Warcrafts and the Diablos, the Call of Duty and all that. All of those were kind of legacy games that have been around forever. Can you pull those into a larger platform that Microsoft is so good at doing? And these are big acquisitions, right? Activision was $75 billion all considered. But there's a lot of IP, and you can use that in the right places. Microsoft is kind of the best-in-class capital allocator of the industry.
Yeah, a lot of the acquisitions. I was trying to emphasize the S there, which I missed the first time. I had a little trouble getting that out there. But the acquisitions they've made recently, it feels like they're one of the only big tech names that have been getting active in that space. And I think that Activision Blizzard one will be a very key for the gaming industry, for big tech, if that is able to go through or not. Yeah, definitely appreciate that. Big shout out to Simon for coming in and answering some of those amazing questions. Brad, I did get a specific question for you to go over one of the earnings for. Let me get back to it. It was Green Thumb. They wanted to hear your thoughts on that. They gave a specific thing in there. So this is secondhand information. So if I don't say it correctly, you'll come in there and correct me in a very eloquent way. As always, appreciate that here for the knowledge. He said, I've noticed the Massachusetts dispensary, a good portion of them stopped being recreational only and medical only. Just wondering your thoughts on that.
Sure. So I think we're referring to what a lot of industry experts call the flippening, which is the schedule and the pace at which states who have already rolled out medical programs end up rolling out recreational programs. And just from listening to Kohler, who's the founder and CEO of Green Thumb, and the other leaders in the industry who I follow, because Charles Bachtell, which is Cresco Labs CEO, and then John Sandelman, which is Air. Those are the three companies I own in the space. All three of them have in recent quarters stopped offering scheduled guidance and timing guidance on when this flipping is going to actually happen, because they are really at the mercy of state and local governments to figure things out, which as I think we can all confidently say, governments are not extremely efficient at moving programs forward and in a very time efficient and rational manner. So I can't comment specifically on Massachusetts stores switching back from recreational to medical, but there have been a lot of false starts, even in the state where I reside of Michigan. That exact same process played out where, okay, now we're selling rec, and a week later we're out of product, and then a week later now we have product back, but we can't sell rec because the rules just changed again and we're no longer compliant. So it really is the Wild West in terms of when these laws evolve and how they evolve and on what schedule. But they will evolve. I mean, if you're just looking at the Gallup polls, and 70% of Americans supporting recreational cannabis, it's no longer a partisan issue. We have Arkansas and Mississippi and South Dakota decisively passing cannabis reform. So it's safe to say this is not a left versus right issue anymore. It is a government get your shit together and give us what the people want issue. So in terms of Green Thumb specifically, the quarter was extremely in line, which was pretty much, again, I was expecting in line, because with American cannabis growth, it's not like software as a service where we add some clients every quarter and get more recurring revenue, and ARR ticks up every single quarter. Quarter to quarter revenue is very much so tied to the pace of cultivation footprint rollout, of opening new stores, of rolling out new brands, and also it's relying on things like stimulus checks lining our pockets that accelerated demand for a few quarters. So quarterly demand, sequential demand, was around 5% for Green Thumb, which I'm expecting to accelerate in 2022. And in terms of why, we just talked about how the timelines for flipping are extremely uncertain, but at the same time, while I can't say when they're going to happen in 2022, it is widely thought of that in New York and New Jersey and Connecticut, by the end of 2022, we will have recreational programs. Virginia is going to flip in 2024, it looks like. Yeah, the other thing I want to point out is I don't think this Minnesota deal that they made is getting enough love. They purchased a company in Minnesota that owns one of only two cannabis licenses in the entire state of 6 million people. So they are one of two vertically integrated operators and sellers of cannabis in a population area of 6 million people. They are a legal duopoly in the state of Minnesota, which I think is going to be a large boon to growth going forward, just considering how ridiculously underserved this population currently is and how large of a footprint Green Thumb now has in that wildly underserved population. Other things that were talked about on the call, we got some long-term margin guidance targets, which I was really excited about. Actually, I should talk about the results first because I feel like that's important to talk about. So small top line beat on the EBITDA line, on the revenue line, on the EPS line. Everything looked really good. They don't offer forward guidance, so nothing to report there. But going back to operational notes and getting that long-term margin guidance. So we got a long-term gross margin guide of above 50% and a long-term EBITDA margin guide of above 30%. So these are consumer packaged good companies at heart. I think a decent margin profile comparison for them. They're not similar products in terms of the use cases. They're somewhat similar, but they're a lot more different than people think they are. But alcohol companies and beer companies. So looking at like Sam's Beer Company operating at a 40% gross margin, and this company confidently telling us they'll be at 50%. To me, that means two things. One, if they can actually do that, that would be absolutely phenomenal in terms of overall long-term returns. And two, these can still be very successful businesses at a 35 to 40% gross margin and at a 20 to 25% EBITDA margin if they can take advantage of the 20% growth CAGR that cannabis is expecting through 2030. There's still a lot to like at much lower margins than these companies are currently guiding to. So it leaves a little bit of a margin of safety there, which I appreciate. Other notes on the call, Ben Kovler was asked about interstate commerce because we talk about federal legalization as a boon for these cannabis companies, and some laws will do things like cut tax rates in half and cut cost of capital in half and allow for institutional investors to finally flood in and buy shares. But what it also will do eventually, after all of those things happen, is it will probably legalize interstate commerce, which means that when you're selling an ounce of cannabis in Washington, D.C. for $550 and doing so in California for a third of the price, that California supply is going to make its way throughout the rest of the country and naturally weigh on gross margins and overall selling prices. So that gross margin at 55% for Green Thumb and some of the other top tier operators, I don't see as sustainable. But again, I think it's going to fall, and I don't think that's going to matter just because these companies are already wildly profitable, and we also have to consider those margin tailwinds that we're going to enjoy. And I'm not saying they're profitable from an adjusted EBITDA perspective. Green Thumb is GAAP net income profitable, but they also get something called 280E reform, which I talk about a lot. Which, if that happens, it would effectively cut their effective tax rate in half, which would be a large boost to net income and free cash flow margins. And then something called safe banking, which would allow for business insurance and uplisting onto major exchanges where they don't currently reside, would cut their cost of capital in half, which for the very best companies in the industry, so Trulieve and Green Thumb, is at a lofty 7%. And for some others with more fragile balance sheets, it pushes 20%. So these are massive costs for these companies right now that are hopefully they should be temporary. I cannot tell you when they're going to go away, and anyone telling you that they know when 280E reform is going to pass or when safe banking is going to pass is talking out of their butt. But it will eventually, because there's such overwhelming support from the public, because there's such overwhelming economic incentives for the state and local and federal governments to be collecting tax dollars that are being foregone by allowing black market sales to continue in a less safe manner, a less safe transactional manner than could be happening in regulated dispensaries. So pretty inline quarter for Green Thumb. Everything looking forward. Everything is encouraging looking forward. There's going to be a large step up in growth this year. They should jump from about 890 million to over 1.2 billion. But we'll see if they do any more. We'll see if they do any more M&A to boost that. Which because they're profitable from a GAAP perspective and because their balance sheet is among the strongest in the space, they should be aggressively buying up assets and they should be aggressively expanding their footprint in this world of finite licensing and finite regulatory restrictions on how many dispensaries can be operating, how much weed can be sold. They should be accumulating as much licensing as they possibly can right now because they are in a better economic position to do so than essentially everybody else in their industry. So it wasn't a quarter to
celebrate and to get extremely excited about, but there was nothing to get worried about either. Pretty much status quo, and looking forward to 2022 and beyond, when a lot of these medical states turn recreational, which has been a large boost to growth in states where that's already happened, and looking forward to more legalization, because I think it's an objective opinion, or there is no such thing as an objective opinion. I think it is all but objective that there's going to be more state legalization in the future, just because Americans of all political ideologies at an overwhelming rate support that regulation. So that was Green Thumb. I've got one left, which is Progeny, but I've spoken for so long, so I want to pass it over to Evan Simon to talk about some other stuff.
No, honestly, dude, I would think for this hour, we're pretty actually about even between you and Simon. So I think we've had a pretty good balance there. We are heading up on the hour, so I am down to continue, but yeah. So I would love to hear any of your thoughts on Progeny. I keep saying it wrong because there's two stocks with a similar ticker, and then we can come back, Simon, if there's anything you want to add as well, any more information, and we can head into wrap ups or whatever we got. Actually, before we do that, though, it's been too long since I got to my amazing co-host up here. Wanted to maybe give him a chance to come in, see if there's anything he wants to add, any questions or any statements. Wolf.
Yo, really enjoying this. Want to take a moment to give a big shout out to the Bullish Rippers account and Stock Market News, who is speaking from it. If you're not already following the Bullish Rippers account, I do 2 spaces a week from that account. Evan does this space and a bunch of really good tweets. So a great follow as we get that closer to 20K. Brad, always a staple of this space. Simon, we got to get you on more. Love the way that you talk and the energy and passion that goes into it. And everything these guys say is just super clear. I felt like everything was understandable. I didn't have to ask for terminology breakdowns or anything. It's clear that they look through balance sheets and income statements and full reports before they made any of their own personal statements. So everything was coming from a place of knowledge, which I really, really liked. On top of that, the one thing which I felt like you kind of asked but didn't really get answered, Evan, was about kind of how many days to wait, or if there's a general rule from a reaction to earnings. Basically, a company you're looking to take a long position or add to a long position, and the company has, let's say, a bad earnings or good earnings, whatever it is. How many days are you typically waiting, or what is your process for making a addition to a company at that point? I thought that one was one which we could elaborate a little bit further on.
Awesome. Yeah. First of all, I'll definitely throw that over to Simon to get his thoughts on that. Side note, Stock Market News, I just got my super follow thing approved. So that's hype. Also, the super follows account super followed to it. So they're actually spending a little bit following everybody who they give added to it. So that's always interesting. But yeah, that's exciting. And Simon, I'll let you answer that question. I was just excited for that. I should have waited till the end.
Oh yeah, I just wanted to add some thoughts about it. Great question, Wolf. Is the reason that stocks move around so much during earnings? Like typically stocks don't do, or I shouldn't say don't do a whole lot, but are not as volatile throughout the rest of the year. And then all of a sudden in earnings, you see these significant pops or drops, 30% plus. Recently, it's because of algorithms. It's because of algorithmic trading that's going on in the market. And depending on the numbers you trust, it's between 80 and 90% of that trading is now software programs, especially institutional software programs, that are saying, okay, I am expecting them to hit X dollars of earnings per share, and they hit Y dollars of earnings per share. So automatically we're going to sell or we're going to buy the stock based on that. And so that is, to me, kind of a knee-jerk reaction from the market. I almost always wait at least a day or two so I can go through the report, listen to the conference call, and make sure I understand what's going on. A lot of times, too, you'll see kind of the after hours numbers. You'll see a stock that, you'll assume, oh my gosh, this must have been terrible. It's down 30% after hours, right after the release. And then the next morning you wake up, you look at the market, it opens up 10%. You're like, wait, what the heck is going on? That's a lot of noise in those algorithms that are trading the stock based on simply quantitative factors. That's fine to do that if you want to, but really to get a handle on what's going on, to be a little bit more qualitative about what the company is doing. That's something we're gonna benefit from as individual investors, because you can't necessarily have algorithms that figure out a strategy or something more qualitative. So I just wanted to add kind of my 2 cents on that. It was a great question that a lot of the short-term trading volatility is really just a bunch of noise.
Yeah, it's not possible to beat those algorithms. You can't be faster than the computer. You can, a lot of times algorithms will overreact in one way, and you can create opportunities in there, react to the reaction. But, getting that initial news break, the algos are there first. It's pretty much, I would say it's impossible. So definitely agree with that sentiment. Perfect. All right. Actually, I am going to kind of slide us into wrap ups. Brad, if as a part of it, you want to kind of throw into the progeny or progeny, just say it one more time for me. How am I saying it?
Yeah, it wouldn't matter at all. I wouldn't correct you unless there was another public company called Progenity, but this is Progeny, so PGNY. And I think I don't even know what Progenity or I don't know what they do, but this is PGNY, which is a fertility benefits company, Progeny. So if there wasn't Progenity in public markets with a very similar ticker and very similar sounding name, I wouldn't care at all. But yeah.
No, I literally am saying the other one too. So it's progeny, not progeny. I was literally saying the wrong one. So progeny. Love to hear your thoughts on that. Hear the wrap up, and then we can go into a little bit of wrap ups after that.
Sure. So similarly to GoodRx, this company is negatively impacted by the slowdown in elective care. Fertility treatments are elective care, but at the same time, they're quite time sensitive. So they're a little bit more insulated, and they are also not 2-3 year courses of treatment. They're a few month courses of treatment. So there's not the same compounding effect and delayed recovery that GoodRx is dealing with. So as a result, Omicron kind of weighed on their results. They quantified that for 9 million, which that 9 million essentially made up the $9 million miss on the top line. But then they further guided, which I appreciate, that into February and now into March, and they have limited visibility into April as well. The trends in utilization rate, which is their key performance indicator to monitor for revenue growth performance, have, and I quote, rapidly recovered. So they haven't used that language in the past. So it sounds like the elasticity of demand or the willingness to come back is strengthening with each variant, and that kind of makes sense considering the lethality of these variants are kind of falling, and hopefully will continue to do so. For the company as a whole, just more execution, continued margin expansion, and I say continued execution despite that revenue miss, because the 2022 guide was quite strong and ahead of consensus expectations. And yeah, they signed more massive companies to their already extensive base of clients, including Microsoft and Amazon and Uber and Unilever and PayPal. But they added SAP. That was one of the new blue chip clients that they announced recently. Again, a metric that I love when companies disclose is this EBITDA margin on incremental revenue, and Progeny fortunately does that for us as well. So that incremental margin is about 1,000 basis points ahead of its current adjusted EBITDA margin. So just another really strong sign that there's more EBITDA margin expansion to come. Other things to kind of highlight, I mean, take it with a grain of salt because they're the C-suite employees of the company or the CEO and the CFO. So they're saying, yeah, our sales momentum is really strong and everything's going well. Hopefully they'd be saying that, but if they're not, we have a real problem. But other things to talk about, they're expanding into Canada next year. That's their second country of expansion. And to me, that was kind of weird because Canada has universal healthcare. So how really can they help? But there was a quote from the earnings call that I can share that kind of made that clear. So Canadian employer supplement coverage of fertility. Oh, no, that's not the quote. This is a natural. Okay. Although the Canadian government provides universal healthcare to its citizens, comprehensive fertility coverage is not included in that program. Canadian employer supplement coverage of fertility is even further behind the U.S. So they've really created a lot of new. So we talk about TAM and pursuing that total addressable market. This company has doubled their total addressable market by making these products both more affordable for the end consumer and more effective for the employer and the end consumer in terms of saving costs and having healthier pregnancies and more frequently healthier pregnancies. I mean, those leads have only been growing consistently over the last 6 years. So how was the quarter? The quarter was fine. They're still dealing with these COVID headwinds that are evaporating and eroding a lot quicker than they are for GoodRx, fortunately, and that is why the 2022 guide was so upbeat. And now, I mean, we're left with a company trading at 28 times 2022 EBITDA, and it's going to grow top line at 50% year over year with expanding EBITDA margins. To me, there's a lot to like about a market share leader with such a tangible value proposition in terms of lower miscarriage rates, higher live birth rates, lower rates of twin births, which can be dangerous for mothers. There's just a lot to like here from both a quantitative and qualitative perspective. obviously in my immensely biased shareholder skin in the game opinion. So please do some research on your own to if I got you excited about the company, to see if you are personally excited yourself, because I could always be wrong about any company I'm talking about, obviously. And then just wrapping it up, thanks so much for having me, Ev. I always love talking about stocks, as my Twitter handle would hint at. Simon, really enjoy listening to you as always, and hope to do a lot more of these with you in the future.
So I know you also like to do write about the earnings reports, news, everything like that on your newsletter. You want to talk us through a little bit on that? I know for all the stocks that you just spit out the information on the earnings report, people can just go to your newsletter and see the full on written out thesis there. But yeah, we'd love to hear a minute or two or whatever you got on that as well.
Yeah, I appreciate the opportunity. So the links in the bio. The newsletter is entirely free. I cover extensively my 24 holdings, some market commentary, but it's really predominantly micro. Aside from when there's a lot of noise surrounding Federal Reserve and stuff like that, I do comment there. But predominantly macro newsletter or micro newsletter for 24 holdings, totally free. Bio or link is in the bio, and you can get to it from StockMarketNerd.com. And yeah, I really enjoy writing about this stuff and sharing what I've learned over the past several years of doing this, and hopefully people gain some insight and knowledge as well from reading it. But check it out for yourself.
Awesome. Yeah, anyone who signs up for that will definitely get some free, immense value out of that. Just in general, big shout out to Brad and Simon for coming up here and making this such a fantastic space. We love having this space talking to long-term investors each and every week. Click into their profiles, check out what they are doing. They both have extra stuff they're doing on the side as well. So kind of click through their profile and just, see what's going on, because they're doing some fantastic stuff. So big shout out to both of them. Big shout out to Wolf for being the Spaces king that he is and helping me co-host this one. And big shout out to Rippers for bringing us all together. We're posting some really cool stuff from this account, hosting some really awesome spaces, including this one. We got regular ones on market analysis, power hours, everything under the sun, industry specific spaces and deep dives. So we're trying to bring a lot of content through Bullish Rippers, and definitely think it is worth your follow. But enough rambling about that. I'm going to keep us moving in the wrap-ups and throw it over to Simon. Anything else you want to add beyond just wrapping it up for yourself? Anything you're maybe watching for the rest of the week? Any extra things you just wanted to get in there? Yeah, floor is yours, Simon.
Hey, Evan, Wolf, thanks very much for having me on this show. This is a fantastic space. I always enjoy it, and it's always a pleasure being alongside Brad. Brad, you do fantastic analysis. It's always nice to learn something new from you on these spaces as well. My final thoughts are that there are good long-term opportunities in the market right now. A lot of people are seeing stocks selling off. They think that the companies are broken. That is not the case at all. Look for great companies that are growing the revenues and the cash flows and have a great plan and have a thesis for why you're investing in a company. Valuation multiples do not tell the whole story. Find the great companies and hold on to them for several years.
Short, concise, and amazingly put. I love that. Big shout out to Simon. Check out his page. Again, click into what he's doing. Hit that follow button. You will not regret it. Big shout out to Brad. And one last shout out to all the listeners for coming here and getting some value out of this spaces. I know with the immense information that was given out there, you did get some value from it. And all those messages we received, seeing people taking some value out of this stuff really is what makes it worth it. So shout out to all of you for coming here, listening to this, listening to the amazing speakers that we were able to come in here and get for you. And very thankful for allowing us to do these spaces and produce some content out for all of you. So it's what makes it fun. It's what makes it enjoyable. It's, what keeps us going. So big shout out to you, all of you. Big shout out to one last time the speakers for making the space so good. Big shout out to Wolf for helping us co-host this, and Rippers for bringing us all together. Make sure you check everyone out here, all the accounts. Hit that follow button, and enough rambling here. I'm gonna end it.